Hello and welcome to the third quarter 2012 investment webinar. My name is Travis Marks. I'm Vice President of Investment and Client Relations. I'm joined with Steve Tuttle. He's the Chief Investment Officer of the company. Steve's going to go through our outlook, our review of the last quarter, our outlook on the markets and the economy, and our strategy for investing the portfolios going forward. If you have any questions, simply ask a question in the chat box, hit send, we'll get to them at the end of the meeting. So with that, I'm going to turn the call over to Steve. Steve?
Good afternoon, everybody. As Travis mentioned, my name is Steve Tuttle. On the screen now are some disclosures to cover some compliance messages for everybody. As usual, we'll just start a little bit talking about what took place the last quarter. And clearly there are many factors that affect how the markets behave in good markets or in bad markets. And I'm generally hesitant to ever indicate one particular factor as driving the markets up or down. But in this case, in the third quarter, I think without a doubt, the key driver of the rally in stocks and other risk assets was the action of the central banks, both in the U.S. With the Fed and over in Europe with the ECB. Their communication and definitive action helped spur the markets up, which was a good thing for risky assets in the short term. Over the long term, we do still have some concerns because as we see it, these actions have not yet been able to fix the underlying problems that face the global economy. And the chief problem facing the economy is simply too much debt. And that has reflected in the economic data that continues to come out. Despite the action from the Fed and the ECB over in Europe, the economic numbers have not been particularly strong. The one exception may be in housing, which does show some signs of bottoming. And most recently, there was a slight improvement in employment numbers in the U.S. market, but clearly there's a lot more work to be done in that area. So we still remain cautious on our portfolios and are ready to act if we see opportunities. Just to highlight what actually took place with the central banks, in both cases, the Fed and the ECB, which is the European Central Bank, they began foreshadowing some new action that they would be taking to support the economy over the summer. And the markets began their rally before the Fed actually and the ECB actually did anything, which is basically the way markets tend to act. They are forward-looking vehicles. So once they get the feeling that some action is pending, the markets start to move ahead of any of that action. So specifically, the Fed came out and committed to purchasing $40 billion of mortgage-backed securities each month. They also extended their commitment to keeping interest rates low into 2015. And the goal of their policy is to stimulate consumer spending and economic growth, and particularly focused on improving the unemployment situation. In Europe, the ECB committed to unlimited purchases of distressed government bonds, and specifically the most distressed and the most in need of this action are Spain and Italy. This had the effect of reducing the perceived and actual risk of widespread debt crisis in the near term. So both actions sent a clear message that the central banks were ready, willing, and able to act to support the markets and prevent declines in the global economy. And on the next slide, the next two slides actually, we're gonna show two charts. This first chart is the S&P 500 index, which is essentially the U.S. large cap benchmark, and it shows how in 3 instances where the Fed came in and announced monetary policy to support the economy and how the markets reacted afterwards. And you can see, I mean, in the areas highlighted, QE1, QE2, and QE3. In each case, that's the major action announcement. And ahead of each of those periods of time on the chart is highlighted when the Fed began foreshadowing that they would be taking action. And you can tell that this action by the Fed has served the purpose of supporting the stock market. Now, while this is good, and clearly our client portfolios have benefited from this, it also creates some caution in our eyes. Clearly, what the Fed is trying to do is encourage investors to take more risk, and that is happening, and that's pushing stock prices higher and other risky asset prices higher. Our concern is that how long can the Fed support these types of assets? And is this just a speculative game that at some point, the Fed is going to say we've done all we can do, and then would money flow out of the stock market? So that's not something that we think is pressing or pending anytime soon, but it is a concern for us over the long term, and it's a big reason why we are not rushing in to increase our risk exposure at this point in time. And the second chart is essentially the European stock market. It doesn't look exactly like the S&P 500, but it does show some similarities. And again, the main takeaway here is in each of the instances of the ECB coming out with a program to support the economy and how the stock market has responded, resulting in an upward trend. Just to highlight our overall view and more of a longer-term view of the economy and of the markets, what we're essentially seeing right now and over the last, really since 2008, is a switch. It's a change from whereas in the past there was a tailwind that was encouraging the markets upwards, and that was driven by increasing in debt, falling interest rates, consumers were buying lots of goods, the housing market was healthy, and there was a lot of risk-taking. All of these events essentially drove a very strong bull market in stocks. Over the last decade, that tailwind has been turning into a headwind, and we really saw the culmination of that in 2008. And essentially what we're faced with now going forward is an environment where debt reduction is the main driver. That's something that has to occur eventually. Interest rates are not falling any longer. They're already at very low rates, and therefore they can only continue dropping so far. They can't go below zero. So at some point, the belief is, particularly with all the stimulus that's occurring, that interest rates can only go up. Unemployment is high now. Risk aversion is also the name of the game these days. Particularly since 2008, investors, both on the retail side and even on the institutional side, have been less willing to pay up for high growth assets and riskier assets. And you see that in fund flow numbers. That's a popular statistic, and what it really shows consistently over the last decade is money flowing out of stock funds and into bond funds. There's also quite a bit of economic uncertainty in the environment, and this has to do with some of the actions by the Fed and the ECB, how they're dealing with the problems that the global economy are having right now, and how will they be resolved. And a lot of this comes down to politics. Increasingly, who is in charge of the government and the central banks is driving policy, and this is driving stock markets up or down. I mean, how often do you, is there a speech or an announcement by a public official, and that causes markets either to sell off or to rise rapidly. It's very tough in that type of environment to invest for the long term, because there's short-term stimulus that's occurring that in many cases has nothing to do with the underlying fundamentals of various stocks and other securities. And then we're also faced with high government deficit and debt, both in the U.S. and in the more developed economies over in Europe. And the likelihood of higher taxes is becoming more and more real. That also would have the effect of depressing returns. So that's basically the case for a slow growth, high volatility environment that we've been speaking about for quite some time. This chart right here really brings into the forefront what I've been speaking about in terms of what has happened to interest rates. And essentially, there was a time when retired investors could quite easily invest in a portfolio of treasuries, savings accounts, CDs, and generate decent yield. Well, today that doesn't exist. This chart today shows how the U.S. Treasury note, how the yield has gradually been declining, and now we're down below 2%. The reason the Treasury market is important is because that's the biggest component of the aggregate bond index. And yields on the Treasury note, as you may know, move inversely to prices. So as people have been buying more Treasuries, rushing to safe assets, yields have steadily been going lower. So the challenge for our clients, many of our clients, in positioning their portfolios has to do with how do you sustain and enhance income streams. I mean, many of our clients are either near retirement or in retirement, and the priority is to make that money last. And the challenge, which we just went over, is that bond yields are low today. Traditional bonds alone are not providing the yield and the income that they once did. As I just mentioned, money is flowing into assets like treasuries and out of other riskier assets. So that has the effect of driving yields lower and keeping them low. And the other concern or challenge is that inflationary pressure is growing. Commodities markets, which are often an indicator of a forward-looking indicator of inflationary pressure, have started to tick up a little bit. So that's a little bit of a concern. So what do we do about that? Well, for our clients, what we are doing is, and have been doing for quite a while, is to seek income in new places. We're not limiting ourselves to just traditional bonds and treasuries, savings account, and CDs. We're also, even more so than in the past, we're taking a more flexible approach. Again, this goes to recognizing opportunities when they present themselves, and then having the patience and the discipline to wait for those opportunities and then to act. And finally, managing risks, particularly for retired investors who want and need income. Even more important than generating income is avoiding permanent loss of capital. So while we are and do prioritize yield for a lot of our clients, we don't look for yield at any cost. The risk factor always has to be a concern, and we have to have belief that the yield or the potential return is justified by the risk we have to take in order to achieve that. So if we could summarize, five main principles for seeking to make income last, what I just mentioned: manage risk. The key is finding the right balance between the risk of permanent loss of capital and the need for income. And often that means accepting some short-term volatility in pursuit of high yields. The tricky thing about managing risk is this means different things to different people. And that's why when you do speak with Travis or myself or John or anyone from the office and you have some concerns, or some questions, it's important that you understand the risk that is inherent in your portfolio, and have an open dialogue so you can find that right balance. And that's one of the things that I think we pride ourselves on is the ability to have an individual conversation with each of our clients and make sure that they are comfortable with their portfolio and that their expectations are appropriate given the risk that's out there. The other main principle is multiple sources of income. It's not enough just to invest in short-term bonds only or just treasuries and savings accounts. Stocks provide income. There's other equity income sources that we've highlighted in a few of our newsletters recently, mortgage REITs, preferred stocks, even some option strategies, structured notes. These are all unique products that are available out there today, each with some individual risks associated with them. But if you can construct them and put them together in a portfolio that's appropriate, you can have the effect of generating multiple sources of income that can provide you with the returns that you need. Alternatives. Traditional stocks and bonds are definitely still the main core component of most of our client portfolios. But there are other products out there today, and they are increasingly finding a place in your portfolios. And some of them I just highlighted: structured notes, some arbitrage funds, other master limited partnerships, other unique securities that we think have a place. They can provide some diversification. They can provide a different source of return, and collectively can smooth out the bumps in your portfolio. Be flexible. That's always been a main point that or a main benefit that we offer our clients, is the ability to respond to opportunities when they present themselves. Part of the problem with being flexible is you don't know exactly when those opportunities are going to present themselves. So it's real important to be patient. For some time now, we've been watching a number of different areas, but we haven't made any major moves in a while. And while that could be disappointing to some, to me, I think it's a credit to our discipline that we are patient, that we are not going to make trades or shift the portfolio around just to show activity. When we do make moves, we want to have a very high conviction level that the moves are going to add value. And then be consistent. That's another similar theme. It's important that we all stay focused on more of the long term. I mean, particularly in a volatile market like we have today, markets move up and down quite rapidly and often unpredictably. And some of these moves do foreshadow bigger moves in the future that we do pay attention to. But many of them, many of the moves are just short-term oriented, and reacting to every one of them would actually be negative for the performance of client portfolios. So what this slide here shows is essentially how we have expanded the universe of securities that we track. And this goes into seeking new sources of income and new sources of return. And if you look at this chart right here, we basically have them divided up into, equities, which are stocks, and you're probably all familiar with those, U.S. stocks, foreign stocks, but also preferred equities, which we don't own in most of our client accounts, but it is something we track. For some clients that prioritize income, we do own some preferred equities, but it is something that when we feel it can add value, we will add them to the portfolio. On the bond side, we've always had a big portion of our client portfolio in investment-grade bonds. And tactically, we look at high-yield bonds, foreign debt, which most recently and currently we own emerging market debt, and then also bank loan funds, which we also own in many client accounts, particularly income portfolios. And then alternatives, and we have this broad category called alternatives, which essentially captures a lot of non-traditional stock and bond type assets. So option strategies, master limited partnerships, mortgage REITs, which we've talked about recently, throw off a lot of income, structured notes, which we've owned in client portfolios, we still do. Just on a side note with structured notes, we had a note that we initiated last summer, 2011, and the note came due in early September, and we are hoping to roll that over into a new note, but we are, again, this gets back to the patience and the discipline. The pricing that we expect for the structured note just isn't available in the marketplace today. So we are we're waiting at this point to initiate a new note. And just so you know, the pricing has to do with what is the return that we can expect or reach for relative to the risk or downside protection that we would be able to accept. And right now, that relationship just isn't attractive enough. So we continue to look at a variety of different notes, but we're not ready to initiate a new note at this time. And then real estate, that's primarily real estate investment trusts. And again, it's something that we've owned in client portfolios on and off over the years. The arrow on the bottom has to do with tactical asset allocation, and essentially what that means, and the reason we're showing it here, is that these are concrete examples of securities that we closely follow, and when we view a particular asset class as more attractive than just traditional stocks or bonds, that's when we add it to the portfolio. And by more attractive, that could be in the form of higher expected returns, but it also could be from lower risk or diversification benefits. And just to go through where we are in most of our client portfolios, you know, we structure the portfolios with three main categories. The core is going to be what drives most of the returns of the portfolio. It's also going to track traditional stocks and bonds most closely. And in terms of the core portfolio right now, we're basically neutral on investment-grade bonds. So we're not overly excited about bonds, but we're also not concerned about the bonds that we own. So therefore, we're holding a fairly normal weighting in client portfolios. On the stock side, we are a little cautious. I detailed some of the reasons why before. So we are slightly underweight where we might be under more normal circumstances. In the tactical portion of the portfolio, there's two main areas that we think are adding value and will continue to add value. One is emerging markets, both on the bond side and on the stock side. We think emerging markets offer a nice combination of attractive valuations, reasonable risk, and decent yield. And for that reason, we own them in the portfolio, and they are actually performing well. And then equity income, and by that we're essentially talking about higher yielding stocks. And we've continued to own a variety of high yielding stock ETFs. They tend to own quite a bit of utilities and healthcare stocks, other securities that throw off a decent yield. And quite interestingly right now, I mean, if you go back to the chart that we showed early in the beginning about the 10-year Treasury yields, which are yielding under 2%, a typical dividend stock ETF like the Vanguard High Dividend ETF yields around a little over 3% right now, which is much more than what you would get in a Treasury. So to us, it's an attractive part of the portfolio. And this also extends from U.S. dividend-paying stocks to foreign dividend-paying stocks. On the alternative side, the structured notes I went over. We continue to like structured notes for our ability to customize a product for our clients. Arbitrage funds we've owned for quite a while, probably closing in on 2 years on arbitrage funds. Quite honestly, they've been a little disappointing in terms of where we would have liked them to be. They're generating, they're performing essentially like a short-term bond fund right now, but they do so without the correlation with the bond market. So I think they do still have a place in our portfolio, and they do have the effect of being able to generate return regardless of what, potentially anyway, regardless of what stocks and bonds are doing. Overall, in terms of our positioning, we're focusing a little bit more on yield, even for us, recently. Some of this has to do with the fact that the Fed seems determined to keep interest rates low for maybe a few more years at least. But again, I mentioned earlier in the presentation, we're not talking about just find a security that yields the most and then load up on it. Whenever we're talking about yield, we have to factor in that risk. So if we can generate yield and we don't think it poses unnecessary risk, we're going to do that with our client portfolios. And then finally, again, I mentioned it many times in the portfolio, flexibility. The flexibility is really going to be, I think, what continues to add value for our client portfolios. That tactical portion of the portfolio, the ability to quickly act and move the portfolio to favor assets that we think offer an attractive combination of risk and reward, should continue to benefit our clients. So with that, I'll turn it back to Travis.
Yeah, I just want to mention real quick, because we're highlighting this high yield, this search for high yield, and the different assets we're looking at, we're adding to portfolios that we haven't done in the past. On client reports, we've done something a little different. We have the pie chart that everyone's used to seeing, where it breaks down different asset classes from cash to large cap stocks to investment grade bonds. We're going to add a dedicated slice to that pie that we're calling high yield, and we're going to put these high yield investments in that slice so you can clearly see where we're finding what we're doing with high yield in your account. If anyone has a question, they can ask it in the chat box if you just expand the program there, you can type it in. But I had a couple of questions real quick. Steve, what would be your opinion on the election and how it affects the portfolios? Everyone I talk to has this question. How are you going to reposition the portfolios based upon the election? And what if Romney wins, or what if Obama gets reelected? What is your advice to an investor out there worrying about that?
To be perfectly candid, I do not think there's any value in investing based on anyone's expectations on the outcome of the election, any election. I mean, it's a very common question. It's popular in the media, but the fact of the matter is, there are a multitude of factors that affect the markets, and policymakers are only driving one component of that. So what we try to do when we're investing our portfolios is see where do we have an edge. So to have an edge by investing according to elections, you'd have to think that we knew who was going to get elected better than anyone else, and then we would also have to know how that would impact the markets better than anyone else. And the fact of the matter is, in our experience, that hasn't proven to be the case. So therefore, without saying that it's not important, clearly it is important who gets elected and how things play out. But the fact of the matter is, predicting that, there's too much uncertainty involved in that. And we think we can add value in other ways. And therefore, we position our portfolios to perform relatively well in a variety of scenarios. And some of those scenarios could be having something to do with elections, but that's not really going to drive the returns of our portfolio. So my advice to someone who's worried about the elections is don't be. It's out of our control, and there are other ways to manage a portfolio than to try to predict who's going to get elected and what that will do to markets.
Okay, that's good advice. And one more question here that I've been hearing a lot about. You know, the markets run up a good bit. It's about doubled from the bottom, not quite from the low in 2009. But we also have these headwinds that you talked about earlier in the presentation. How would you advise someone who's worried about a big pullback in their portfolio? Generally, I mean, obviously we're not fully invested in stocks, and some of the portfolio is going to go up. But what would you say in addition to that?
The main message is to avoid trying to predict things. The markets are going to behave the way they're going to behave, and really what's driving markets up or down is, in large part, events that are occurring and moving markets in unpredictable fashion. So because of all the uncertainty, because of the risk that we see out there, rather than trying to predict and make moves ahead of something that might happen or might not happen, what we've done is position portfolios, we think, to participate in most of the upside and avoid a lot of the downside. And if you can consistently do that, and we have a pretty good history of being able to do that, if you can stick to that plan and avoid the worst of the downside and participate in a lot of the upside, well, guess what? Over the long term, you have very compelling returns, and that's our strategy. To predict or to try to predict what's going to happen, or to decide, you know what, this doesn't feel right, so I'm going to adjust my portfolio, well, that's a very dangerous game. And particularly for retired investments, retired investors, it's been my experience that you can do more damage to your portfolio by investing on feelings rather than discipline. And so that would be my advice.
Okay. So with that, we don't have any additional questions. And with that, I just want to thank everyone again for their time and their support, their business, their trust. If you have any questions for me or for Steve or for John or for your advisor, just pick up the phone, give us a call, send us an email. Until the next webinar, stay well and have a good holiday, because it'll be past then. So take care, and thank you again.